Every business eventually buys big things: machines, computers, vehicles. But the moment they're recorded in your books, something important begins. Their value starts going down, not randomly, not instantly, but methodically through a process called depreciation. In this video, we're breaking down long-term assets and depreciation, the kind of accounting concept that shows up everywhere, from balance sheets to budgets and even tax returns. If you've ever been confused by straight line, book value, or why land never depreciates, this explainer will make it click, once and for all. Long-term assets, also called fixed or non-current assets, are the big tools a business uses to operate over time. These aren't things you buy and sell every day. They're investments that help the business run for years, not months. Think machinery, buildings, delivery trucks, office furniture, or production equipment. On the balance sheet, you'll find them listed under non-current assets because they're not expected to turn into cash within the next 12 months. They hold value, they serve a purpose, and they slowly lose value over time. And that's where depreciation comes in next. Not all purchases are treated the same in accounting, and this is where the difference between capitalizing and expensing matters. When you capitalize something, you're recording it as an asset, not an expense. That means it goes on your balance sheet, and you spread its cost out over time. Think buying a delivery van or a new machine. On the other hand, expensing means it gets used up quickly. It hits your income statement right away, like office supplies, fuel, or a one-time ad cost. Here's the rule. If it provides value beyond 1 year, capitalize it. If it's short-term and consumed quickly, expense it. This decision directly affects how profitable your business looks, and that's why it matters so much. When you buy a long-term asset like a $10,000 machine, you don't just expense it all at once. Instead, you spread that cost over the years it helps your business. That spreading process is called depreciation. Think of it like this. Your machine will wear out or become outdated. Depreciation reflects that gradual loss in value. It's not about market prices going up or down. It's about allocating the original cost of the asset across its useful life. For example, if the machine lasts 5 years, you might depreciate $2,000 per year. That way, each year carries a fair share of the cost. Important. Only tangible assets depreciate. That means physical things like equipment, vehicles, buildings. Land never depreciates, and intangibles like patents are amortized instead. We'll cover those later. Now let's talk about how depreciation is calculated, because there's more than one way. Straight line method. The simplest and most common. You spread the asset's cost evenly over its useful life. Here's the formula. Cost, salvage value, divided by useful life. Example, you buy equipment for $10,000, expect to sell it for $1,000 after 5 years. That's 10,000 minus 1,000 divided by 5 equals $1,800 per year. It's clean, consistent, and widely used for financial reporting. Double declining balance, DDB, a form of accelerated depreciation. More expense in the early years, less later. Here's the formula. 2 times straight line rate times book value at start of year. For that same $10,000 asset, you'd calculate 40% of the remaining value each year. It reflects how some assets lose value faster early on. Units of production method. Depreciation is based on actual usage. Great for things like machines or vehicles. Here's the formula. Cost, salvage value, divided by total estimated units times units used this year. Example, if the asset will produce 100,000 units and you make 20,000 units this year, you depreciate 1/5 of the cost. It's more precise, but it requires tracking usage closely. Every year you record depreciation, it builds up in a special account called accumulated depreciation. This account offsets the asset on your balance sheet. So what's the book value? It's the asset's original cost minus its accumulated depreciation. Here is the formula. Book value equals cost minus accumulated depreciation. Example: equipment costs $10,000. After 2 years of straight-line depreciation at $1,800 per year, accumulated depreciation is $3,600. The book value is now $10,000 minus $3,600 equals $6,400. Important, this doesn't affect your cash, it's just how you record the asset's reduced value over time. Now here are some common mistakes students, and even businesses, make when it comes to depreciation. Forgetting the salvage value. Always subtract salvage value before calculating depreciation. You can't depreciate what you plan to recover. Applying the wrong method. Using straight line when accelerated is more accurate, or vice versa, can distort your financials. Depreciating land. Land doesn't wear out, so it's never depreciated. That's a textbook red flag. Not updating the depreciation schedule. Every year, every asset needs to be reviewed. If you miss it, your balance sheet and income statement will be off. So that's long-term assets and depreciation. Clear, simple, and essential. You record the asset when it's bought, spread the cost over time through depreciation, and always choose the right method for accuracy. Remember, only depreciate tangible assets. Land is never depreciated. Salvage value matters. Your balance sheet and net income rely on this being done right. These aren't just accounting details. They're the building blocks of how businesses measure what they own and how that value changes over time. If this video helped depreciation finally click, hit like, subscribe, and drop a comment below if you want a full walkthrough of fixed asset disposal, asset impairment, revaluation, and updates. You're doing great, one topic at a time. Let's master this together.